Now to our highlight, Isabel Schnabel. Thank you very much, Isabel, for joining us. We have been, as I was saying, already trying for a few years whether you would be able to make it, and this year it actually worked. There is an issue of silence periods, and the ECB does decide every now and then to either change interest rates or not, and then the people on the board can talk about this not before and not immediately after, but today Isabel can talk. We are very curious about what you're going to tell us. Just two highlights out of Isabel's CV, which is long and very long as the Amazon, as somebody said one day. But to me, two important points. She was a professor at Mainz, and we overlapped there. She has been a professor at the University of Bonn in financial economics since 2015 and still is on leave from there. And since 2020, she is on the executive board of the ECB. You remember 2020, that was a difficult year. And to start out at the ECB when just everything was about crashing certainly was one of the tests that of an interesting time that you have had, followed by a few more. Isabel has made a name for herself with her speeches. They are usually important topics. They are widely read and quoted, and I can also say that usually her charts and slides are super, super good and easy to reuse, to copy. I am really looking forward to your speech to us today. Isabel, the floor is yours.
So good afternoon, everybody. Thank you so much, Beatrice, for the very kind introduction, and of course for giving me the opportunity to speak at this fantastic symposium, which has become one of the must-attend events in Europe. And congratulations for building this in such a short period of time. So monetary policy is at a critical juncture. The growing confidence in a sustainable decline of inflation towards our 2% target has allowed the Governing Council to remove substantial policy restriction over the past 6 months. And with our decision last week to cut the 3 key policy rates by a further 25 basis points, the deposit facility rate is now at 3%, 1 percentage point below its peak. So we are now navigating towards neutral. And I will argue today that with interest rates approaching neutral territory and with risks to the inflation outlook broadly balanced, monetary policy should proceed gradually and remain data dependent. In this way, we can ensure that disinflation does not stall above our 2% target, while avoiding unnecessary weakness in the labor market and the economy at large. I will also argue that once price stability has been restored, the challenges for monetary policy will change. As inflation becomes dominated by idiosyncratic shocks again, central banks can afford to be more tolerant of moderate deviations from target in both directions. Incoming data and the new Eurosystem staff projections have confirmed that the disinflation process remains well on track. You can see our projections of inflation and real GDP growth on this slide. Inflation is now expected to decline towards our 2% target in the course of 2025 and to oscillate around this level over the projection horizon as domestic price pressures ease and base effects from energy prices fade. Growth has been revised down, but is still expected to accelerate next year as consumption and investment recover on the back of rising real incomes and less restrictive financing conditions. As ECB staff continue to project that the euro area economy will expand at a pace around its potential growth rate in the coming years, inflation should neither over nor undershoot our 2% target materially over the projection horizon once past shocks have fully unwound. Three factors support the assumptions underlying this projected recovery. One is the upside surprise to growth in the third quarter, with private consumption picking up and inventories no longer weighing on growth, as you can see from the yellow and dark green bars on the left-hand side of this slide. A turnaround in the inventory cycle would remove a significant drag on aggregate demand. Second, as shown on the right-hand side, confidence in the retail trade sector, the blue line, as well as consumer expectations for major purchases over the next 12 months, the yellow line, continued to improve in November, while savings intentions declined somewhat. Third, according to model-based analyses illustrated on the left-hand side of this slide, over the next 12 months, an economic expansion is still much more probable than a recession, despite the prospect of more trade barriers clouding the euro area economic outlook. Although the baseline forecast does not incorporate the potential impact of concrete policy measures of the new Trump administration, as these remain uncertain, recent sentiment indicators are likely to partially reflect the surge in trade policy uncertainty already. According to one indicator shown on the right-hand side, trade policy uncertainty is now even higher than in 2018-2019. Empirical research suggests that rather than the actual tariff increase itself, it is the rise in uncertainty that will be the main drag on growth. But these effects are often estimated to be short-lived, with growth rebounding sharply once uncertainty fades. The staff projections are therefore consistent with bringing interest rates to a neutral setting as inflation stabilizes sustainably around our 2% target. The question then is how fast we should remove policy restriction. Our decision last week to cut our key policy rates by 25 basis points reflects the conviction that a gradual and data-dependent approach remains the most appropriate strategy. And there are three reasons for this. First, while we are increasingly confident that price stability is within reach, an important part of disinflation has yet to materialize. Services inflation, in particular, remains high at 3.9%. At the same time, momentum indicators, such as the 3-month on 3-month rate, suggest that price pressures have started to ease. But such signals critically depend on the way the seasonal adjustment is done. For example, shifts in households' consumption patterns in the wake of the pandemic may be making the seasonal adjustment more difficult. Estimates by financial market participants suggest that when correcting for these potential shifts, momentum could be measurably higher than what our current estimates imply. Indeed, over the past 2 years, November has turned out to be a notable outlier in terms of the month-on-month change in services inflation, as you can see from the red circles on the left-hand side of this slide. Also, while the baseline scenario assumes a cyclical recovery in productivity growth that is expected to ease the growth in unit labor costs, hysteresis effects or other structural factors could weigh on productivity and investment over an extended period of time. Recent scenario analysis conducted by ECB staff and illustrated on the right-hand side shows that in that case, growth would be lower and inflation higher, 0.3 percentage points cumulatively by 2026 than in the baseline. These effects would rise notably if the forces weighing on productivity growth were more permanent. So, even if most of the evidence points to continued disinflation, we should remain alert to signs that cast doubt on our baseline. A gradual approach allows us to react to such signs. Second, new shocks keep hitting the euro area economy, many of them posing upside risks to inflation. Gas prices, for example, have doubled since February, as you can see in the yellow line on the left-hand side. As a result, wholesale electricity prices, the blue line, have increased substantially. Food prices, too, have started rising at a concerning pace at an annualized 3-month rate of 4.6% in November, up from 0.9% in May, the yellow bars on the right-hand side. Moreover, climate mitigation measures are increasingly affecting prices over the medium term. In 2027, for example, Eurosystem staff expect inflation to rise above 2%, slightly, mainly due to the planned expansion of the EU emissions trading system to buildings, road transport, and small industry. In addition, while the direction and persistence of the various effects of potential tariffs on inflation are ambiguous, their net effect is often estimated to be positive. While a decline in foreign demand for euro area goods, as well as trade diversion, especially from China, are likely to be disinflationary, several channels could mitigate or even offset these forces. For example, the EU may retaliate with tariffs of its own, as it did in 2018. Also, the parallel impulse to the US economy coming from expansionary fiscal and supply-side policies could support foreign demand, even as tariffs increase, because many products are not substitutable in the short run. Finally, since the end of September, the euro has depreciated by more than 6% against the US dollar, largely in anticipation of the incoming US administration's economic policy intentions. And this is already putting upward pressure on import prices. Such inflationary shocks are of particular concern in the current environment, as people are paying more attention to inflation after recent experiences. The latest Eurobarometer reveals that inflation remains people's biggest concern in most euro area countries. This attention makes inflation expectations more vulnerable after a long period of high inflation. Proceeding gradually allows us to respond to new shocks in an environment of elevated uncertainty and volatility. Third, a gradual approach is the most appropriate course of action the closer we are getting to neutral territory. There are two related sets of benchmarks for monetary policy. One is simple Taylor-type policy rules that are used in most structural models to replicate the systematic response of monetary policy to movements in inflation and growth. While such rules need to be treated with caution, they are a useful policy benchmark. As there are many ways such rules can be formulated and estimated, it is helpful to use a thick modeling framework that reduces some of the data and model uncertainty. Such a framework, depicted on this slide, suggests that the median rule in yellow points to a gradual dialing back of policy restriction. It also suggests that the distribution of projected interest rate outcomes is skewed to the upside. The second benchmark is the natural real rate of interest, R star. There is no consensus on what its main drivers are or on how to best estimate it. As a result, the range of estimates is exceptionally large, both within and across models. Recent analysis by ECB staff across a suite of models suggest that the point estimate of R star ranges from about minus 0.5% to 1%, or about 1.5% to 3% in nominal terms. This is similar to recent estimates by economists from the Banque for International Settlements. Significant parameter uncertainty makes it even more challenging to use the natural rate as a guidepost for monetary policy. In this uncertain environment, it is helpful to focus on what has changed in recent years, to understand whether real equilibrium rates could be higher today than during the 2010s. An increase would warrant a more cautious approach by central banks removing policy restriction. Changes in the demand for and supply of global savings suggest that equilibrium rates may indeed have increased in recent years. The pandemic, Russia's invasion of Ukraine, and other shocks have led to an increase in public debt around the world, as was discussed before, and as you can see on the left-hand side of this slide. Net borrowing by governments remains substantial. In 2024, the public deficit, shown on the right-hand side, will be around 5% of GDP across advanced economies, and it is expected to decline only marginally in the coming years, also reflecting borrowing requirements associated with the digital and green transitions. The IMF projects that in the coming years, overall global investment, public and private, will reach the highest share in GDP since the 1980s. It is likely that, as a result, real interest rates need to rise to clear the market for savings. This may especially be the case as rising geopolitical fragmentation contributes to reducing the supply of savings, including those provided by price-insensitive investors. In the United States, for example, the decline in the share of foreign official holdings of US Treasury securities has accelerated in recent years, as you can see on the left-hand side of this slide. It is now at the lowest level in more than 20 years. Incidentally, since about late 2022, asset swap spreads started to widen measurably in both the euro area and the United States, depicted on the right-hand side. This suggests that investors are gradually demanding a higher return to warehouse the supply of global public bonds. These developments are contributing to the reversal of the global savings glut, which put notable downward pressure on real rates for the greater part of the 21st century. And this has repercussions for the assessment of the monetary policy stance. For example, given the notable increase in real short-term rates expected to prevail in the distant future, which are often taken as proxies for the natural rate, the policy stance today may already be in neutral territory as real spot rates have started to fall below their equilibrium levels, as shown on this slide. Other indicators point in a similar direction. In our most recent bank lending survey, for example, 93% of banks report that the general level of interest rates no longer plays a role in explaining weak loan demand. This contrasts sharply with a year ago, when almost half of the banks said that interest rates were a factor contributing to lower demand. Similarly, the survey on the access to finance of enterprises shows that the pressure from interest expenses is gradually easing. The net percentage of firms indicating an increase in interest expenses fell from 36% to 19%, reaching similar levels to those recorded at the end of 2021. Finally, among households, we have observed a notable turnaround in the demand for housing loans, as you can see on the left-hand side of this slide. A net 39% of banks reported higher demand in the third quarter, a share close to the historical peak of 45% and well above the historical average. This increase in the demand for housing loans is broad-based across countries. Banks expect it to continue, reflecting both the decline in mortgage rates and improving housing market prospects. The right-hand side chart shows that in the second quarter, the euro area house price index rose for the first time in more than a year. All this suggests that we should proceed with caution and remain data dependent, assessing at each monetary policy meeting whether disinflation remains on track and whether and to what extent interest rates remain restrictive. In doing so, we can continuously cross-check the assumptions underlying the staff projections and thereby retain a forward-looking perspective. And this is especially important at a time when past pandemic-related shocks are starting to recede and new shocks are increasingly driving price and wage dynamics. And this shift in regime from a high inflation environment to one where inflation is consistent with price stability has two important implications for the conduct of monetary policy. One is that it has a direct impact on the effectiveness of monetary policy. The success of central banks in paving the way towards restoring price stability after the recent inflation surge has a lot to do with how monetary policy works. In a high inflation regime, price increases tend to reflect factors common to most goods and services. And this is what happened in recent years. The common component of inflation rose sharply as firms reacted to the combination of higher energy prices, supply-side bottlenecks, and pent-up demand after the pandemic-induced lockdowns. This was reflected in the rapid broadening of inflation pressures across the goods and services contained in the consumption basket, which is illustrated on this slide. Ultimately, these shocks affected all sectors of the economy, especially when second-round effects pushed wage demands higher across firms. Wage price spirals are often the clearest sign of a regime shift, when changes in the general price level become a coordination device for price and wage setters. As monetary policy affects aggregate demand, as well as the inflation expectations of both firms and households, it is powerful in counteracting such common shocks, as shown in a BIS analysis depicted on the left-hand side of this slide. As this process is nearing completion and we are re-entering a regime of price stability, idiosyncratic price shocks that reflect relative price changes and that are mostly independent of each other will again dominate in driving aggregate inflation. And this is reflected in the measurable decline of the common component. BIS analysis also shows that idiosyncratic prices tend to be less responsive to changes in aggregate demand and hence to changes in monetary policy. See the right-hand side chart. As a result, monetary policy becomes less effective in steering overall inflation. Central banks then need to carefully weigh the benefits and costs of trying to lean against relative price shocks. The strongest case for acting is when prices start to co-move again, either because of a new large shock or a series of shocks that moves prices in the same direction. But in the absence of such shocks, policy should be careful not to overreact. And this is especially the case if idiosyncratic shocks reflect structural forces. While it is inherently difficult to separate cyclical from structural factors, surveys among firms suggest that a significant part of the current weakness in parts of our economy relates to forces outside the realm of monetary policy. In our latest corporate telephone survey, for example, firms reported that the recent decline in business sentiment was driven by growing concerns about political developments, both in Europe and globally, and waning competitiveness amid high energy costs and the green transition. Firms express concerns about rising regulatory costs, such as those resulting from the Corporate Sustainability Reporting Directive or the Corporate Sustainability Due Diligence Directive. Compliance with these and other directives is seen as complex and resource-intensive, especially for smaller firms. In other cases, such as the General Data Protection Regulation or the AI Act, there's mounting concern that regulation is increasingly stifling innovation and competition, especially in important areas such as AI. Particularly in Germany and France, these structural headwinds are causing businesses to postpone or even refrain from transformative investments and focus instead on efficiency and cost cutting, which in turn is weighing on consumer confidence and spending. An expansionary monetary policy stance will change this dynamic only marginally, if at all. Recent research by Oscar Jorda, Sanjay Singh, and Alan Taylor corroborates this view. As illustrated on the left-hand side of this slide, the effects of tight monetary policy can be persistent, but central banks cannot boost potential output by bringing rates into expansionary territory. And while the benefits of using monetary policy to deal with idiosyncratic shocks are likely to be limited, the welfare costs that it has for society can be significant. One of the costs is that relative price adjustments support the efficient allocation of resources within the economy. Leaning too strongly against them in the absence of clear risks to price stability may inhibit this process. The other is that valuable policy space is lost and will not be available to support employment and growth when the economy faces shocks that monetary policy can deal with more effectively. This was the case when the pandemic hit. At that time, interest rates were already close to their effective lower bound. As a result, central banks needed to resort to unconventional policy instruments. However, the effectiveness of such measures in stimulating aggregate demand is more uncertain, while their potential side effects are larger. The second implication is that when relative price shocks dominate, inflation is largely self-stabilizing. As a result, central banks can have a greater tolerance for moderate deviations of inflation from target in both directions. The reason is that the impact of changes in aggregate demand on inflation is weaker in an environment in which price changes are largely independent from each other. That is, the Phillips curve is highly nonlinear. Its slope is often steep when inflation is high, and it is flat when inflation is low. In this environment, it takes a large shock to aggregate demand for inflation to measurably and persistently drift away from the economy's nominal anchor, our 2% target. So there is less need for policy to respond to moderate shocks. And this is especially true for disinflationary shocks. Overwhelming empirical evidence suggests that nominal wage cuts are extremely rare and that the frequency at which firms adjust prices lower is highly stable over time, as you can see from the red line in the right-hand side chart. And when prices and wages do not chase each other, as they did over the past years, inflation is largely self-stabilizing, and as such, the risk of falling into a truly harmful deflationary spiral is limited. Monetary policy can then be more patient and allow inflation to deviate from target for longer than in a situation in which risks of second-round effects are larger. This can also be seen in the historical properties of commodity price shocks. When oil prices fell sharply and persistently in 2014, the path-through to consumer prices and wages was moderate. Underlying inflation, while weak, never fundamentally drifted away from our 2% target. But in 2022, when inflation was already rising on the back of the repercussions of the pandemic, firms raised their prices considerably and much more frequently than when inflation was low and stable. So let me now conclude with the three main takeaways. So first, price stability is within reach. Considering the risks and uncertainties we are still facing, lowering policy rates gradually towards a neutral level is the most appropriate course of action. Second, once price stability has been restored in a sustainable manner, the behavior of inflation will change, such that central banks can afford to tolerate moderate deviation of inflation from target in both directions. Given limited policy space, monetary policy should focus on responding forcefully to shocks that have the capacity to destabilize inflation expectations by pushing inflation measurably and persistently away from our 2% target over the medium term. Third, monetary policy is not a supply-side instrument. It cannot resolve structural issues that durably weigh on price pressures, as was the case during the 2010s, when a highly accommodative monetary policy stance over a long period was unable to lift the economy out of the low growth, low inflation environment. Structural policies are the responsibility of governments. Thank you very much.
Thank you, Isabel. You have agreed to take a few questions, is that right? Yes. So I see, maybe let's have a show of hands. Yes, Pierre, you go ahead. You have a microphone in your seat.
So that's, oh, that doesn't work? Oh, does it? This sounds much better. That's, of course, a very good question. Let's see. So we have to think about it. I mean, we certainly, if you look back to our previous monetary policy strategy review, and Pablo was also part of that. I mean, we were, of course, in a very different world, and we had very different concerns than we have now. I mean, back then, the reaction function we defined had a very strong asymmetry due to the effective lower bound. And maybe with the experience that we have now, such a strong degree of asymmetry may no longer be appropriate. And we have to think about what that means. I mean, so President Lagarde said very clearly, we are not going to touch the target as such. And I think this target has served us incredibly well. It's very easy to communicate. You have the 2% symmetric over the medium term. I mean, medium term is maybe a bit fuzzy, but that also can, I mean, that's actually quite important, that it's not too precise, but we are not going to touch that. But still, then the question is, and I think for me that's one of the biggest questions we will have to answer. So how do we respond to moderate deviations from these 2%? And the answer, I mean, you can give different answers. I gave one answer today, but that is certainly my personal view. It's not the view of the Governing Council as such, or at least not yet.
All right, Yuri.
Yes, please use the microphone.
Thank you. I have two questions. One question is how much you think spillovers from U.S. monetary policy are going to affect the ECB policy. The most recent forecast reported by the Financial Times suggests that the projection is that the Fed is going to keep monetary policy tighter, or maybe tight, for foreseeable future. That's number one. And the second question is, in our textbooks, we often say that if it's a temporary transitory shock, the monetary policy should not really react to this and kind of let it dissipate and so on. My impression is that everybody, kind of the general public, is so scarred by the recent inflation experience that nobody is going to tolerate another increase in inflation. And maybe there is a reason to be kind of more aggressive, even to moderate temporary transitory shocks. Thank you.
Yeah, so two very interesting questions. So on the first question, I mean, I think
we have demonstrated convincingly that we do our own monetary policy on the basis of our own analysis, of course taking into account all the spillovers that exist through the economy, through financial markets, and so on. And of course we have good control of the short end of the curve. I think where the spillovers may be more problematic could be in the long end of the curve, and that is something that has to be seen. So, I mean, in the past, there was this very strong correlation of term premia, and we haven't seen that, by the way, in the past couple of weeks to the same extent. But I wouldn't be surprised if that came back. If you believe that term premia in the US are going to rise, which I think is the case, then we will have strong spillovers from the US that we then need to deal with. So that's but maybe that's not directly monetary policy, but it's maybe more fiscal policy actually. Then on your second question, I alluded to that very briefly in my speech when I talked about the vulnerability of inflation expectations. And I mean, there is now all this research which shows that kind of experience matters. And once you have experienced inflation, it somehow you're more attentive to what is happening on the inflation side. And I mean, the hope, of course, is that we can, by our decisive action and our success in bringing down inflation to the 2%, that we can convince people that we are entirely committed to the 2% target, which then also helps us to anchor inflation expectations going forward. But we cannot entirely exclude that this is going to be more difficult going forward. And we know now more than we knew before how much people hate inflation. And of course, we weren't I think we were not even aware how comfortable that situation was. We were in this very comfortable situation where the only people who cared about inflation being too low were central bankers. Nobody else, of course, cared. It was because there was this kind of rational inattention. But now, of course, we are out of that. The hope is we can get back there. And but it also, of course, depends. I mean, if we face more inflationary shocks going forward, climate change, geopolitics, whatever, it may be difficult. So let's see.
Thank you, Isabel, for your speech. Two small questions. The first one, you said in your speech that the essential question was to decide on the speed of navigating to the neutral, and then you gave us a very wide estimate of the neutral, which nevertheless, if the essential question is about the speed, you seem to have yourself or the ECB a more precise notion about where the neutral is now, so that you are worried with the speed of converging to it. The second question, you listed certain reasons for possible upward inflation shocks that may happen. You mentioned natural gas, you mentioned the exchange rate, but also in terms of the energy, the oil price is going in the opposite direction. And we have to count of one of the Trump policies that is anti-inflationary, which is the famous drill, baby, drill. And there are already experts in the oil market predicting oil prices below 60 by the end of next year. And that, for a region that imports a lot of energy, is very important. In a forward-looking monetary policy, shouldn't you count with, indeed, that sort of shock on energy prices overcoming the elements that you mentioned, and of course, the exchange rate. What counts is the effective exchange rate, and what we have now is a strong dollar against all currencies. So our effective exchange rate has not increased as much as the 6% you mentioned. Thank you.
Yeah, but there has also been an effect on the effective exchange rate. But I mean, so on, I agree to many things you said. And by the way, I said that I see inflation risks at this point as being broadly balanced, okay? So on the energy prices, I think on the oil prices, I think you're perfectly right. And this is, of course, also part of our projections. I mean, I'm a bit concerned that, you know, if I look at our, I mean, I'm not paying too much attention to projections like 3 years ahead, but we produce them, so I have to look at them. If I look at the 2027 projection, and I ignore now the ETS2 issue, then that number actually doesn't look all that high. And the reason is that at that time, energy price inflation, which is derived simply from futures, is actually at the end negative, which is of course much lower than what it was in at any time in history. It's very low, very low. So if anything, I mean, I think there could be, you know, there could be a slight upward risk there. So the projections are already very conservative there. Same on food prices. In food prices, I mean, I fully take your point on the drill, baby, drill. On food prices, I mean, I think most of us probably would say, I mean, there are risks stemming from climate change, extreme weather events, and so on, which are pretty one-sided. I don't know, but again, but still, the futures, and we know futures are not necessarily a good forecast of what prices are going to be for commodities. But there again, we have food price inflation well below historical averages. So it remains to be seen. On your first point, so no, we have no clue. I mean, some people give numbers, you know, in public. But we really don't know. And it's not that, you know, when we're together secretly, that we say, oh, we all know it's this number. We don't tell anyone, but that is the number. But I think we honestly don't know. There are different views. Some people believe it's a bit higher. Some believe it's a bit lower. Some people believe it has moved up. Others say maybe not. And so the question is, how do we deal with that? So the models don't tell us much. I mean, if you have the Holsten-Laubach-Williams estimate, and it has a standard error of 6 percentage points, I mean, what can you do? 6 percentage points. I mean, this is big, very big. So the only thing I believe we can do is we really have to look at, I mean, what indications do we have? I gave you some indications telling us maybe it's already getting a bit, you know, less restrictive. I mean, others may then again have a different view, but in the Governing Council, I mean, that's a nice thing. We have different views around the table. We discuss extensively. I always say any single argument that you could ever have thought of is going to be there in that discussion. And then in the end, I think most of the times we're taking reasonable decisions, maybe not always. But because we have all these arguments that are brought up and that are put together. But honestly, we really don't know. Otherwise, it would basically be simpler. It would be simpler to at least, you know, give a sense of, you know, where we want to go and so on if certain things happen. But I'm not sure we can do that.
I agree with you, and then we should not use the concept. We can have no idea of where it is.
Yeah, but I think conceptually, I think it's useful still, because it gives, I mean, we have to think about what could be directionally the factors shifting it up or down. And I personally find that quite useful. And again, then we can have a debate on all of those factors and where we stand. So I find that useful. But I know, I mean, then of course giving numbers is very dangerous. I must admit, I've also given numbers, but only because others have been given numbers, and then you're kind of forced into this game of giving numbers, and even though I think it's not a very serious thing.
Please introduce yourself.
Yeah, my name is Kai Afa. I'm working at the Banque de France as a research economist. And I have a question on relative prices. You mentioned relative prices, and you've shown also that there's again an increase in food prices, some energy prices, which are necessity goods, right? So inflation in this kind of goods is more hurtful for poor people. And there is some evidence, for example, by Xavier Jaravel and co-authors, that this is also a phenomenon over the long run, that there is some inflation inequality more hurtful for poor households. Is this something that the ECB is looking at? Or if there are any numbers on the euro area for that? Thanks.
Yeah, so I mean, we've been looking a lot also at these heterogeneities. I mean, so this question of inequality does not directly enter our policy debate. I mean, somewhat through the secondary mandate, where you could say, if it comes to our own policies, that if we have different measures, they have different impact on distributional aspects, we should choose those that have lower impact, something like that. But on the analysis side, of course, I mean, we are doing a lot on heterogeneity, maybe I can. I mean, you probably know the people already who you have to contact on that work. But I mean, there is of course a lot, and this is in reality, of course, that's a crucial point. It also matters, of course, for transmission, as we know, and but it also, in the end, then it also matters, of course, for politics. Very important point.
Well, thank you very much. I think we have to close it here. And thank you one more time to Isabel, please. And I have to ask you to stay here for a little bit longer. Because we have this tradition of springing prices, surprise prices on people at the CEPR. And we also have a tradition which is not so long, but we want to establish as a tradition that we actually give prices that are not the usual type. And one of the unusual type of prices that we decided a while ago is to, award a prize for people who do public service by going from being academics to being policymakers, decision makers, advisors, and possibly going back. Possibly they stay on the other side, but definitely they are still in touch with academia. They are still in touch with us. And ideally they have been or they are a CEPR fellow. So you have guessed it, Isabel is all of those. She has been a CEPR fellow forever. She is a distinguished fellow now. And one of the pleasures of our common attempt to work on moving the needle on the euro area stability, as you remember, was a memorable paper that we wrote together with seven Germans and 7 French, in brackets. I am neither, but I can pretend to be both. So Isabel, it's really with a very big pleasure that that the jury has decided that we would want to award to you the CEPR Prize for Service to Economic Policymaker 2024.
Thank you so much.
This is easy.
So thank you so much. That was a real surprise. Thank you, Bea. I mean, let me mention, I still believe that this paper that you mentioned, I mean, was one of the most important papers I've contributed to. I still believe it has many aspects that are very important. I mean, it had this idea of combining risk sharing with market discipline, which kind of serves then both those who are afraid of risk sharing and those who are afraid of market discipline, by combining the two in a way that the outcome then is much better. And I still believe one can go back to that paper and learn many things about what should be done, and we should take it up again.
We should read it again, because
yes, indeed.
because it's so easy to forget what you have written. But I agree, I think it was good. Can you please all move forward to have a picture taken, and then we have to leave the building as said. I hope to see you all at the Pinot collection after that. And and can we have all the ladies ladies first? All ladies in the front, they just look so much better.